This chart tracks Donald Trump's net worth during his first term in office. After years of flatlining, the numbers trended downward, hitting a low point in 2021. His wealth was tied to a legacy of brick and mortar, towers, luxury hotels, and golf courses concentrated in major cities. Because these locations were Democratic strongholds, his presence in the White House alienated the core high-end client base driving his revenue. Following the events at the Capitol in 2021, the fallout accelerated. Major social platforms banned his accounts, severing his audience, while institutions like Deutsche Bank, his primary lender for 2 decades, cut off his credit lines entirely. Significant legal liabilities further strained his balance sheet. A civil suit filed by writer E. Jean Carroll resulted in an $88 million judgment, followed by a New York State fraud ruling that ordered hundreds of millions in penalties for inflating asset values. In the span of a single year as a sitting president, his net worth jumped from $2.3 billion to $6.5 billion, the most profitable period in his 50-year business career. It raises a central question. How did a man facing near total financial and legal ruin executed the most profitable presidential term in American history? The details of this strategy are contained in the public record. As president, he filed a detailed 2025 income disclosure spanning over 900 pages. Analyzing complex financial filings to spot market shifts is a core focus at Stewardship Finance Academy. They host a free stock investment masterclass that teaches you how to read financial reports and build resilient portfolios. You can register for free right now using the link in the description. Applying that same analytical framework to Trump's 900-page disclosure reveals how his family business overhauled its playbook to monetize the presidency. This figure represents the cash revenue flowing into the Trump family operations in 2025 alone, $2.21 billion. It is important to note that this is actual cash flow, not just the appreciation of his assets on paper. To understand the source of that cash, we have to look back to the original Trump blueprint. He learned that placing his name on a hotel property allowed him to charge a 30% premium, and because he didn't own the building, that 30% was pure profit. During his second term, he applied that same premium to political access. Mar-a-Lago transformed into a direct line to the sitting president, driving membership initiation fees from $100,000 to $1 million. This chart shows how those fees added up. The private club and resort division generated $485 million. He also generated $86.5 million settling lawsuits against media companies. Finally, despite Truth Social reporting massive losses, a corporate merger raised over $2 billion. Simultaneously, Middle Eastern sovereign wealth funds directed $3.5 billion into private equity ventures, led by his son-in-law, Jared Kushner, alongside billions in new international licensing deals for Trump-branded resorts. The strategy shifted away from the risks of traditional real estate. Instead, the family moved into high-margin licensing and fees that require almost no capital investment. But the largest revenue engine in the 2020 disclosure, accounting for over 2/3 of his total income, was digital. This chart tracks 3 crypto channels. First, the U.S.D.1 stablecoin captured $197 million in interest yield. Next, selling governance tokens netted $590 million. Finally, the Trump coin meme token spiked to $75. Together, these digital channels generated $1.4 billion in liquid cash. This represents a total evolution into digital IP monetization, making his physical properties a secondary part of the business. How is it legally permitted for a sitting U.S. president to operate these commercial ventures from the Oval Office? U.S. Federal Code, specifically 18 U.S.C. Section 208, prohibits executive branch employees from participating in matters that present a personal financial conflict of interest. However, Section 202 of that same code explicitly exempts the president and vice president from those restrictions. Historically, Congress left these positions exempt to avoid over-constraining the chief executive. They relied instead on transparency laws, assuming that mandatory disclosure would force a president to self-regulate to avoid voter backlash. In this case, that logic was inverted. Full financial transparency allowed these commercial operations to function openly and legally in the public eye. He leveraged specific federal exemptions and digital markets to establish a new precedent for personal wealth while in the Oval Office. To learn how to analyze financial data for your portfolio, click the link below to join the Stewardship Finance Academy Stock Investment Masterclass.